My name is Tim Blumentritt, and this presentation discusses the characteristics of goals and performance metrics in strategic management. The focus here is on the goals that executives set for their firm and how they judge performance relative to those goals. This material builds on our earlier discussion of strategic leaders. Before I move into the details of goals and performance assessments, recall this depiction of the context in which strategic decisions are made from the Strategy Foundations lecture, the first in this course. While the top two boxes are the basis for the SWOT analysis, the bottom two boxes are pertinent to establishing goals and objectives. The personal values of key stakeholders ask decision makers to consider what the most important stakeholders, typically the owners of a firm's capital, want from the firm. The box on societal considerations asks decision makers to consider what role the firm wants to play in its communities. Considering all four of these factors simultaneously, particularly how they fit together, determine which goals the firm will set for itself as it pursues sustained strategic performance. This presentation touches on only a few types of measures that can be used for setting goals or monitoring performance. But regardless of which measures the firm actually adopts, a few considerations apply across the board. Each strategic goal is just one in a portfolio of goals. Because a goal sets the firm on a pursuit to achieve it, each goal has to be examined for its interactions with others. Trade-offs arise when one goal interrupts or competes with another to the point that they are incompatible. Trade-offs often arise between departments. For instance, a marketing team may want to allow for far more customer modifications in pursuit of sales goals, while a production group may want to be as consistent as possible in pursuit of efficiencies. When trade-offs arise, how they are resolved reveals the firm's true priorities. Of all possible goals, those that receive funding and attention are the real drivers of decisions, activities, and investments. This is true even if lip service is paid to other goals. Last, it's always better if the goals and objectives are clearly measurable. Firms often use scoreboards or dashboards as displays of key metrics, and these gauges are helpful in keeping everyone on the same page. However, some goals and objectives are impossible or very difficult to measure, such as employee satisfaction. Sometimes latent measures, rather than direct measures, will be all that is available. The starting point for setting goals and establishing performance measures is a firm's business definition. The business definition captures what key stakeholders want from the firm, as articulated by mission, vision, and value statements. Also, as discussed in the Strategy Fundamentals presentation, mission statements describe what a firm does in the present, vision statements describe what a company hopes to achieve in the future, and statements of values describe the attitudes and perspectives that the company hopes will pervade in the actions and decisions of its employees. The business definition creates a foundation for goals and performance measures. Every goal that is set should contribute to the firm's mission and be a stepping stone to its vision. Conversely, a goal that is outside of these boundaries, even if it would be a legitimate goal for a different company, is out of bounds. Importantly, strategic management both determines what a firm does as well as what it doesn't do. These boundaries are set by a firm's vision and mission statements, as well as its goals. The title of this presentation suggests two topics, goals as well as performance assessments, but they are really two sides of the same coin. Both are focused on directing a firm's efforts and serve as the foundations for one another. There are key differences, however. Goals are future-focused. They set down what a firm hopes to achieve in some set period of time. This means that near-term and specific goals should align with the firm's mission, and longer-term and more developmental goals with its vision. Performance assessments, on the other hand, are reflective. They happen at the end of a given time period and are often inputs for learning and strategic adjustments. Another key difference between goals and performance is who performs them. The lead on setting goals is the organization's top executives. While these people certainly will be influenced by their stakeholders, they have discretion in determining which goals are achievable, motivating, and realistic. Performance assessments, on the other hand, are typically led by others. That is, an executive should have input on the goals that are set, but the CEO or the board gets to determine if they were met or not. One final point. Note that both goals and performance assessments are purposeful and intentional. This differentiates them from outcomes that just occur without management targeting them. But that doesn't mean that unintentional outcomes can't be any less impactful than sought-after goals or precise assessments of performance. Happenstance, being in the right or wrong place at the right time, or simply getting lucky can have major implications for the fortunes of a company. I also want to differentiate between absolute goals and relative goals. Some goals are measured on their own. For instance, salespeople often have quotas to meet, and production managers have delivery schedules to keep. These types of goals are either met or they not, and they are not compared to the output of anyone else. Other goals are measured by degrees of change or against some benchmark. For instance, say a firm had a goal of earning $12 million in a particular year. If it makes its number, then the absolute goal has been met. But the outcome can also be compared against other results. If last year's earnings were $10 million, shareholders should be happy. But there can be multiple reference points. Even if earnings went from $10 million to $12 million, a 20% increase, shareholders might be quite a bit less happy if the firm's primary competitor achieved 30% growth in the same time period. Let's now move into various mechanisms for setting goals and measuring performance. Importantly, consider the items listed in this and the next few slides as options for senior managers. While these items will be important to every company, firms will place more emphasis on some of them than on others, indicating their priorities and trade-offs. Senior management teams utilize market indicators as strategic goals to bridge the gap between daily operations and long-term enterprise value. An efficient supply chain, defined by characteristics such as flexibility and resilience, ensures that the firm is well positioned to acquire the resources it needs to deliver its products and services to customers. For all companies, but especially service firms, this includes being able to attract strong people as employees. Maintaining a robust competitive position, as indicated by strong market shares and excellent reputations, serves as a benchmark for brand dominance and market power. These types of goals not only drive financial results, but they are also indicators of power and influence. Being regarded as an innovator means that customers will look to that firm first when new technologies or social pressures become important. Finally, prioritizing solid customer relationships through measures such as strong Net Promoter Scores and high retention rates acts as a proxy for future revenue predictability and reduced acquisition costs. These types of goals indicate that the people who make buying decisions in the firm's industry want to do business with the firm on a consistent basis. By setting specific targets in these areas, executives move away from reactive financial reporting toward proactive value creation. These goals align the organization's internal resources with external market realities. Financial indicators provide senior management with a quantitative framework to measure the health and sustainability of their strategic decisions. By setting goals across the three primary financial statements, leadership ensures that the firm is profitable, stable, and self-sustaining. Income statement goals, such as top-line growth and net margins, are often primary drivers of executive decisions. Their visibility makes them regular measures of performance. While revenue growth indicates market demand and successful sales execution, margin targets ensure that the firm is scaling efficiently. Goals centered on a solid balance sheet, such as maintaining healthy liquidity ratios and an enabling capital structure, act as indicators of the firm's solvency and creditworthiness. Finally, focusing on the cash flow statement, especially free cash flow in the cash conversion cycle, ensures that the business can fund its own operations and return value to shareholders without over-reliance on external debt. Targets for free cash flow are often very important to senior leaders, as they represent the dollars available for dividends, reinvestment, or debt reduction. By transforming these metrics into formal performance goals, executives move beyond mere accounting and into the creation of strategic targets. These indicators provide a clear language for accountability, allowing the leadership team to communicate the company's internal strength and external reliability to investors and stakeholders. Firms also set targets based on improving their valuation. This is an external view of a firm's performance, as it measures how investors evaluate its recent results and its prospects. For publicly traded firms, valuation is measured by market capitalization, computed as stock price times number of shares outstanding. For privately held firms that have reasons to be interested in their valuation, such as firms held in private equity portfolios or those that may be sold in the foreseeable future, the EBITDA multiple that they would command is a good proxy for a stock price. Valuations are influenced by a number of factors that are related to a firm's activities. Stock prices tend to improve if a firm has solid fundamentals, such as a healthy capital structure, a strong market position, and a track record of growth. These are factors that result from the firm's past performance. A firm's current conditions signal the health of the firm's existing trajectories. Last, investors consider a firm's prospects for the future to capture the benefits that come with growth and development. While they are often correlated, valuation can tell a very different story about a firm's performance than its financial statements. Uber's stock price history provides an easy example. Even though the firm was founded in 2009 and completed its IPO in 2019, it did not report a full-year profit until fiscal 2023. All those years of losses didn't stop its valuation from moving a great deal, including stock price peaks in 2021, in response to investors considering its future prospects. In all, market capitalization serves as a direct goal for executives to maximize shareholder wealth. It forces leadership to balance current earnings with long-term strategic narratives that drive the stock price. In the private sector, focusing on EBITDA multiples pushes management to improve the firm's quality of earnings. In either case, by targeting valuation growth, executives are encouraged to manage the current performance, even while articulating a vision that justifies a premium price today for earnings expected tomorrow. Last, some companies overtly pursue non-market and non-financial goals. Doing so can create several benefits. These firms tend to avoid risks of regulatory or legal problems by setting standards that are well above those required by law. They tend to attract well-meaning people as employees, and they often are rewarded with excellent corporate reputations. There are several established frameworks for judging these kinds of performance measures. The United Nations Global Compact encourages businesses to align strategies and operations with universal principles on human rights, labor, environment, and anti-corruption, and take actions that advance societal goals. It promotes these 10 principles as well as 17 Sustainable Development Goals, which I encourage you to look up. Further, many firms sponsor charitable and philanthropic giving through corporate foundations and structured volunteer activities. For example, Target Stores has for years directed 5% of its profits to its Foundation for Community Support Initiatives, and Home Depot has a Team Depot website where its employees can sign up for volunteer opportunities. Charitable and philanthropic donations, in the form of both money and time, have multiple performance ramifications. Firms who dedicate resources to these efforts believe their costs are offset by supporting employees when they contribute to causes they believe in, and the reputational boost these firms earn through their contributions to their communities. To reiterate an earlier point, recall that all of the potential goals covered in the last few slides also can be used as performance assessments. Executives can set goals for any or all of them: market indicators, financial returns, firm valuation, or societal contributions. Once set, those goals establish the targets for strategic decision-making. Then, sometime in the future, reviews should occur to see if the goals were met, why or why not, and what can be learned from the effort to achieve them. Shifting gears a bit, I'd like to emphasize a couple of points, both with the intention of embedding a ROI mindset in this class. First, it is important to keep in mind the varying levels of analysis that are in play when considering a firm's goals. As mentioned in an earlier lecture, strategy is something that happens at the firm level of analysis, meaning we consider a company as a singularity. This is to say that Apple offers technology products, Google provides search and AI tools, and Ford produces cars. An entire company is the focus of strategy and strategic decision-making. In the end, everything a firm does, as a whole, should be focused on generating the best outputs, be they financial, market, or social, from the resources they expend in pursuing them. But in actuality, firms are comprised of many different departments, led by people who have very different incentives, backgrounds, and training. This means that a firm's overall portfolio of goals has two meaningful characteristics. First, any particular goal is going to be treated and pursued quite differently in various areas of a firm. For instance, a stock price reflects firm's overall performance as monitored by the CEO, but each area of a firm will seek to contribute to a strong stock price in their own way. The CFO will focus on financial efficiency and management of risk. The VP of operations will pursue operational efficiency and high quality. The CMO will drive customer lifetime value. The CTO will ensure all systems run seamlessly. And the CHRO will find the best employees that salary budgets will allow. On the flip side of that observation is the inherent conflict that can arise among the departments, because every firm has limited resources that they can allocate to those various areas of the business. The CFO will make sure those limitations are top of mind. However, financial discipline means that the CTO can't buy all the technology that may make systems work even better. The CHRO will have to pass on great people whose salary demands are too high, and the CMO will have to limit how much is spent on acquiring or retaining customers. In effect, the different areas have to compete for limited budget allocations, creating debates, perhaps even arguments of where dollars are best spent in the pursuit of overall firm performance. In all, even as executives together pursue firm-level outcomes, especially as considered through the lens of ROI, opportunity costs and trade-offs abound in setting goals and judging performance. Following in the same mindset, strategy demands a broad, inclusive definition of the figures inherent in computing ROI. In finance, the computation is simple: net returns divided by total investment. Here the numbers speak for themselves. Accounting for a true ROI in terms of strategic initiatives is much more difficult. This is because business activities require not only allocations of dollars, but factors such as effort, time, processes, and human energy. For instance, while it is easy to compute an employee's total compensation, it is far, far more difficult to calculate the contribution to strategic performance that the employee made over a period of time. Every one of us knows people who are more or less productive, even among groups of people who make about the same salaries. This same logic holds in every aspect of a firm's activities. So when considering new strategic initiatives, the strategist must account for these dynamics. It's not only money that is a required investment for putting new ideas into action, it is also overcoming the inertia that is part of every organization and its established practices. To briefly conclude, a firm's goals and objectives should naturally flow from its mission and vision. Performance metrics are the flip side of goals, as they provide a chance to review the firm's effectiveness in achieving the targets it set for itself. Every firm can select which goals it wants to pursue, but when selecting goals, they will reveal what their priorities really are, because trade-offs are unavoidable. And this concludes the presentation.